it's going to say all real estate activity, no matter what, is going to be default considered passive activity. And any loss that's in the passive spectrum can only be used to offset passive income. It can't be used to offset non-passive income, like W-2 income, for instance, for a medical doctor, right? And because of that, you got into a scenario where a lot of people got upset because there were a lot of people who were actually engaged in real estate activity, but not necessarily on a day in and day out basis. So in 1987, 1 year after the passive activity loss rules went into effect, Congress got so many much hate mail, that they made a little bit of an exception. They said, okay, we've heard you. If you are actively engaged in the trade and or business of real estate, then you can take a passive loss and use it against your non-passive income. All of the steps that are required in order to get outside of something called the passive activity loss rule, right? So prior to 1986, there was no rule. It was the Wild West when it came to real estate. And what happened was you had a scenario where ultimately what was going on is a lot of these medical doctors in California specifically were sending money to these REITs, right, these real estate investment trusts. And the REITs were sending back these depreciations every year that the doctors were using to offset their medical practice income. And they were paying nothing in taxes. And Ronald Reagan got a hold of this and was like, I don't like this. This doesn't seem fair. And Ronald Reagan was like very much pro-business, but it just seemed unfair, right? Because these doctors were doing nothing in real estate, like at all. They were literally just writing a check, sending it away. So what happened is some members of Congress got together and they said, you know what? This does not seem fair because the rule was made for real estate professionals. It wasn't made for medical doctors, right? We want to sponsor real estate development because the government tries to incentivize things it believes are going to be good for society, right? The tax code has two purposes. One purpose is to raise revenue. That's what most people believe. I think that's also fictitious because we don't raise anywhere near the revenue we actually spend every year from taxes. But the second rule or the second purpose of the tax code is to incentivize action, right? It's designed to incentivize you to do certain things, to engage in certain type of activity or to not engage in activity. And it incentivizes you with 3 carrots: deductions, credits, and exclusions, right? And this process that was around was they tried to incentivize real estate activity by giving you the ability to have losses, and those losses could offset your income. And those losses could be phantom in nature, meaning they didn't have to be actual dollars out of pocket. They could be depreciation, right? So all these doctors were taking advantage of it, and Congress said, no, let's change the rules. So they changed the rules in 1986. President Reagan signed it into law, and the rule change said this. It's going to say all real estate activity, no matter what, is going to be default considered passive activity. And any loss that's in the passive spectrum can only be used to offset passive income. It can't be used to offset non-passive income, like W-2 income, for instance, for a medical doctor, right? And because of that, you got into a scenario where a lot of people got upset because there were a lot of people who were actually engaged in real estate activity, but not necessarily on a day in and day out basis. So in 1987, 1 year after the passive activity loss rules went into effect, Congress got so many much hate mail, that they made a little bit of an exception. They said, okay, we've heard you. If you are actively engaged in the trade and or business of real estate, then you can take a passive loss and use it against your non-passive income. Remember what we talked about earlier on today? The 11 criteria for the active trade and or business of real estate? Well, that's what this is, right? The 11, well, that's not touchscreen. The 11, yeah, maybe it is touchscreen, right? Yeah, it is. It's a whiteboard. Come on, Edward. There's a whole download that you can get here, a whole PDF that you can print out that goes over all of those separate different things that you can engage in. You can go and watch the actual mastery, right, itself. You can go into the mastery itself and get access to everything it has to offer. It's a little over an hour and 14 minutes. I literally walk you through step by step how to qualify for an exception to the passive activity loss rules. I'll give you a summary here. There are two main ways that you can use a passive loss against your non-passive income. The first is to qualify for what is called real estate professional status. That are the 11 activities in the trade and or business of real estate. You have to engage in those activities for at least 750 hours per calendar year, and let me say this again, and it must be your primary activity, which means the vast majority of people can't qualify because you're doing something else. And if you're doing something else full time, that would mean you'd have to engage in those 11 activities for 41 hours a week, because 40 hours are spent something else. So you have the primary thing you're doing has to be real estate, one of those 11. Now, the rule is one of those 11, but you can actually combine them by doing something called grouping. You can elect to group a bunch of different activity together so that you count it towards that one 750 hour per year goal. The interesting thing, though, is if you're married, just one of the taxpayers has to qualify. Both taxpayers benefit. So typically, one spouse who may not be working could become the real estate professional. The other spouse who is working does not. Doesn't matter. It's one tax return. Both taxpayers benefit from one getting the status. When you qualify as a real estate professional, that means, again, those passive losses can be pulled over to the non-passive income environment to offset that non-passive income. So in this scenario that we were laying out here, what was the dollar amount we found? It was like $131,000, I think. Yeah, $131,000 of actual tax savings, because it could be used to offset $468,000 of non-passive income. So let's say you have a business that you're engaged in, you're actively engaged in that business, and you earned $500,000 of income. You can use $468,000 of deduction against it so that your actual taxable income is $32,000, right? Drastic ability to save. So that's the one method of getting around this passive activity loss rule, and that is called the real estate professional status. As long as one taxpayer in a married couple qualifies, the whole tax return benefits. The second method is what is referred to as the short-term rental exception. What this method does is this requires a few things to happen as well. First, you have to spend at least 100 hours engaged in one of those 11 activities. 100 hours, so not 750, so it's much easier to do. And, let me say that again, and, it's a multi-part test, and the management of the underlying property is primarily conducted by you, meaning no one else can work more on that property than you. And, again, and the average rental term for that property per tenant is 7 days or less. 7 days or less. Think VBRO, Home Away, Airbnb, short-term rentals, right? That's the whole concept behind the short-term rental. I do want to qualify both the short-term rental and the real estate professional status also require you to own at least 5% of the underlying investment. You have to own at least 5% in order for it to qualify. That's just a participation test. You have to actually own the thing you're managing. But if you have that scenario where you're in a situation where you are short-term rental and you are engaging with tenants who are staying in your property for on average 7 days or less, you're managing it primarily, no one else is working more in the management of that property, you qualify for the exception. And only one party needs to do it. And in fact, in that category, both parties together can accumulate the 100 hours, meaning one spouse could do 50, the other spouse could do 50. Right?
So there you have it. Hopefully you've taken significant nuggets of wisdom out of that vicarious opportunity to learn. You see, I know that many were not able to attend a session like that live, but hopefully you've been able to take something out of that experience so that you can start to put it into practice within your own life. But before you do that, I do have a question for you. How would your life be different? Imagine for a moment that you were part of a community that engaged in discussions just like this all of the time. Well, there is such a community. It's called the Uplevel Community. It's a community filled with business owners from all across the country that are all interested in the same thing that you are, taking your life and your businesses to the next level. Now, if you're interested in jumping in to explore what that community can look like and how you could potentially benefit from being part and parcel to this collaborative environment of business owners from all over the United States, all different industries and all different stages of their respective entrepreneurial journey, all you need to do is check out that link in the description below. I can't wait to see you on the inside. Bye for now.